Powell's use of the word restrictive and saying that the real interest rate was well above the neutral rate, and that defines restrictive. So half of the solution is understanding the problem. If the economy weakens as much as we think it's going to, the Fed is now getting into the mindset with the use of that word, and we might see a pivot faster than might ordinarily be the case. After all, M2 is down roughly 4%. It has been down on a year-over-year basis for 8 months.
While many investors and economists are preoccupied with the specter of inflation, ARK Invest founder Cathie Wood is out with a more contrarian view. Wood lays out a perspective that challenges conventional wisdom. The real economic risk isn't inflation, it's deflation. Cathie Wood expects interest rates to fall, and surprisingly so, which is the opposite of the higher for longer interest rate environment to which the Federal Reserve alludes. Take a look at some of these earnings reports. The headline will be, "Oh, they beat their revenue and earnings." But if you look deep into it, the guidance has been falling for a long time, and many companies are showing little to no nominal growth. She said. In other words, while the numbers may look promising, Wood said digging into it underlines an unsettling trend. Nominal revenue growth is diminishing, and by some measures, real revenue growth has been negative for the last 2 quarters on a year-over-year basis. According to Woods, this is going to be a harder landing than most people think. She also added that inflation went from 9.1% in June of last year to a little over 3% in July. Money growth has been negative on a year-over-year basis since the beginning of the year, something that will impact the economy with a lag. Let us now get into the video as Cathie Wood sheds more light on this topic and why she thinks this would be a very hard landing. Please don't forget to like this video, subscribe, and drop your comments.
What do we have to look forward to? Well, now the topic is potential government shutdown if there's no agreement on the budget. And just like with the debt ceiling, this is going to work out. We're moving into an election year, and no one wants to be seen as disrupting the government and bringing that kind of attention during an election year. So there'll be a lot of saber rattling, but we'll probably land at something in and around September 30th. And then this week we got some clarification. The IRA, the so-called Inflation Reduction Act, which we do not believe that's the reason inflation is going down, but nonetheless, we knew that that this administration was going to target drug prices, and we got the 10 drugs. They're associated with large pharma companies, and it was interesting that the stocks actually went up because most of these drugs, if not all of them, are scheduled to go off patent in the not too distant future. And so their prices were going to come down anyway. So while the administration said that the price declines would be somewhere between 20 and 60% for these drugs, and a lot of them are for the highest spending categories that Medicare is trying to control, heart disease especially. Most of the prices, when they go generic, will drop by 80%. That's what usually happens. Now, there will be more drug price cuts, but they're not going to happen until well after the election. So we don't have to worry about it right now. And if the administration were to change, there may be new legislation countering this legislation. One of the things we are focused on, though, in terms of fiscal policy is if we're right that the economy is going to have a harder landing than most economists and strategists expect, what will this administration do to counteract the bad news during an election year? And I think the bond market is already a bit on the warpath when it comes to fiscal spending. The words out of control seem to be bandied about constantly in the press. And I can't imagine there's going to be another layer of spending, but it is a risk. It is a risk. And I think the bond market will not take too kindly to it.
The consumer is already at a breaking point, Wood said, using Domino's Pizza as an example. Back in February, Domino's Pizza CEO Don Mage admitted to making a mistake in trying to raise prices in an attempt to fight inflation, which resulted in a loss of units and a 20% blow to its profit margin. Coca-Cola is another example, Wood said, noting that the byproduct of near double-digit price increases has been negative unit growth. Well, these are manufacturing companies that kills productivity, she said, warning of a cycle that could set in. Wood further cited a report ARK Invest received indicating that consumer delinquencies are rising much faster than anticipated, potentially foreshadowing a troubling trend. Let us now get back to the video.
The yield curve is still inverted, roughly 70 basis points. And that's a harbinger of slower than expected or lower than expected inflation, or both. And we think both will be the answer there. And the yield curve has been inverted for a year now. Now, many people are probably sick and tired of this talk about any landing. You know, they're hearing soft landing, hard landing. And most are thinking it's soft landing now. We are thinking harder landing, but how hard? It's probably not, it's certainly not going to be anything like 08, 09. Why? Because we've been in a rolling recession for about a year. As you'll recall, in the first half of 2022, GDP was negative for 2 consecutive quarters. Technically, that's the definition of a recession, but we don't know when the NBER, the National Bureau of Economic Research, is how they're going to characterize this. We won't know for 1 to 3 years, I think, after the fact. But we know that that housing is back down to COVID lows. And we know that autos are still in a very soft spot in the 15 to 16 million unit range. 17 and a half has been normal, 13 in a recession. So it could go down a little bit more. Inventories, we're hearing in this earnings season, big declines in inventories, especially at retail. In some cases, double-digit inventory declines, so 15%. So that's going to hit in the third quarter. Most retailers report through July. So that's interesting. Now, those are some of the most cyclical indicators or cyclical sectors when it comes to economic activity. Capital spending is starting to weaken now as well. But if we have the most cyclical sectors already having experienced some kind of recessionary condition, this landing is not going to be deep. What is it going to depend on? It's really going to depend on the consumer. And in turn, that will probably depend on the unemployment rate. And we'll get to that in a moment. We did get the employment report today. But if the unemployment rate goes up, then consumer spending, we think, given the very low saving rate, 3.5% now, was before COVID around 8%. So it's down to 3.5% now. And the end of the moratorium for student loan payments, which is in September. That could be a double whammy. So consumption is what's going to determine the kind of recession we're in. And I do believe the consumer is on strike also against price increases. We saw and heard a number of companies in earnings season saying, yep, we probably went too far. Even Domino's said it. We probably went too far. We need to readjust pricing. So many people do not believe we will see deflation in the CPI.
Wood's deflation-centric viewpoint offers a crucial alternative lens for investors. With companies like Domino's, Pepsi, and Coca-Cola serving as canaries in the coal mine, there's evidence that nominal and real growth is under considerable stress. Wood's perspective, which is reflective of her overall investment thesis, underscores the need for investors to look beyond inflation as the only economic bogeyman. It suggests rethinking traditional valuation models and understanding the nuanced threats and opportunities that deflationary pressures may present. European Central Bank (ECB) officials seem irked that they are not being taken seriously by markets, risking a show of force in Frankfurt that may seem at odds with a struggling euro economy. As August consumer price numbers revealed a picture of only slow, sticky Eurozone disinflation and ECB hawks warned against halting rate hikes prematurely, money markets stuck doggedly to bets the campaign is at least on pause, but more likely over. After 425 basis points of ECB policy rate rises to 3.75% over the past year, that market take seems uncontroversial given a halving of headline inflation since October, business activity contracting again for 3 months in a row, credit tightening and economic surprise indexes consistently negative since May. But with inflation still more than twice the target and long-term market expectations, like those in the US, settling in on a 2.5% landing zone rather than the stated 2% goal, some officials fear ECB credibility is being challenged, and that may affect price setting in the wider economy. To be fair, the level of uncertainty on what happens next, both within the major central banks and the investment world, is high and rising. Long-term visibility is unusually low. What do you think of Cathie Wood's macro outlook on the economy? Let us know in the comment section below. Also, make sure to give us a like, subscribe, and turn on notifications. Thanks for watching.